Stephen Meade again, back again with another Bullseye Guy podcast. Super excited for the interview today. I'm interviewing Robert, who has a book out. We're going to talk about history of the stock market, finance, and looking forward. So, Robert, give us, again, I always joke, it's the perfunctory. Who are you? Introduce yourself. Tell us about yourself.
I've been in the investment business for 50 years. I started at Value Line as an analyst, distinguished myself, and then had a couple of stops before I arrived at Axe out in Tarrytown, New York. As an analyst, I was a member of an 8-person research department, and my work got recognized early on. Every equity account in-house was underperforming the market. So I was asked by the president of the company to start work on the Axe Out Stock Fund, which was their flagship portfolio. In 1978, after a 6-month stint, I was given full responsibility for the stock fund and managed it to 6 straight years of outperforming the S&P 500, culminating in 1983 with a return of 118%, which placed second best in the mutual fund industry. During that time, I was getting noticed. I had one of the early employment contracts in business, and I was really wedded to the company. But because I was besieged with a lot of offers, I decided to take a shot at opening an investment firm myself. I did it the hard way. I didn't start out with any assets, so it was a laborious process. We built target investors to a very sizable investment firm, and over that 22-year period, my track record was 20.4% annualized. In many years, I was rated as among the many top managers in the country. And then the bear market of 2000-2003 hit, which made most of the momentum funds. I'm a momentum fund manager. I'm a quant manager. Aggressive growth, I fall into all those boxes. But the bear market of 2000 to 2003 was very severe, as measured by the NASDAQ dropping 78%, which is depression-like. Like other investment funds that were momentum-driven, most of the assets went away. So in 2005, I closed the business, moved my family to South Carolina, continued to do my research, where I spend most of my time, and to work on family office matters. A few years ago, always feeling that my research was special and that it was very valuable, I decided to enter the hedge fund business. And the model that we're using today, we are going on a 1-year anniversary. It's called the Golden Eagle Growth Strategy. In the first 11 months, the fund has returned 127%, investing in 25 of the world's fastest growing companies.
Wow. And so we're already ahead. We'll go back and come forward. But the last thing you said, is that a fund? Is it a mutual fund? Is it an actively traded account?
It's an equities hedge fund, long oriented. We do use leverage. We don't really do much in the way of shorting, because the evidence at hand shows that the vast majority of hedge funds that short the market are well behind the S&P 500, and they're also well behind the equity hedge fund aggregates, according to certain data banks. Very difficult to short the market. In 1982, the Dow was trading at 1,000. Today, the Dow is trading above 33,000.
Yeah.
So shorting into an ever-rising stock market is a very, very difficult task.
Yeah, we won't even go down that conversation. I had to do a short cast on GameStop and shorts, and who I think should go to jail by resetting the hedge fund shorts and locking out. There's a bunch of inside baseball on that one. But let's go back. So talking about, sort of your background and history, there's a lot of history around the stock market and how it's been used as a vehicle over time. How would you explain the role of the stock market in terms of the growth of the country and growth of companies?
We're going through a tug of war now between capitalists and socialists and progressives, which want to put more constraints on the stock market. But all these people that are critical of the stock market have no insight, have no knowledge of history, what the stock market has done for this country and raising our collective standard of living to #1 throughout the world. Without the stock market, the North would have not won the Civil War because they were able to finance the North forces where the South did not have Wall Street on its side. All they did was print money, and by the end of the Civil War, their economy collapsed. Inflation was running at about 9,000%. In World War I, before the United States entered the war, the big investment houses in this country, like J.P. Morgan, Seligman, Kidder Peabody, were financing Britain. And they allowed Britain to stay in the war for 2 years. The United States entered in 1917. At the time that Great Britain ran out of money, we came to their aid in many ways. So without Wall Street, the United States would not have won World War I or World War II. In addition to that, the services provided by state, local, municipal governments would not be possible today because Wall Street is instrumental in going out and getting investors to buy their bonds in order for them to function. A lot of the things that I've just talked about are really lost on the American public, and they don't understand how significant Wall Street is in our society. The total amount of stock and bond offerings today probably approaches $175 trillion. To put that into perspective, the US budget right now is about $4 trillion. So Wall Street is absolutely critical to our well-being and level of prosperity.
Yeah, and we do a lot of work in that too, as you and I spoke. I mean, I've had different companies, but a lot of times I have to explain to people the different functions of the stock market and then the different levels of risk. You know, the OTC micro caps are very high risk, volatility, you know, returns. You've got NASDAQ, you've got the NYSE. So they perform different functions in different levels. From a standpoint of how companies have utilized the stock market and capital markets, how would you say that's changed over time from, you know, some of the early regulations, 30s, 40s, and 50s, some of the collapse? There's been these ebbs and flows through time. What have you seen over time that's changed within how companies use capital markets?
Okay, first of all, there's an overemphasis on risk. Investors are always talking about risk. Rarely do they talk about returns. I appeared on a panel a couple of months ago, and there were 3 other panelists, and the subject of volatility came up, and the other 3 managers said, well, we're going to diversify more. The untold story in diversifying more, yes, you are going to reduce risk, but you're also going to reduce return. Now, I've been publishing on this in the past year, and many people have come to the conclusion that the stock market's overvalued because it's selling at a historically high PE in the mid-20s compared to a historic norm of 16 times. Most investors don't understand what has happened to the stock market over the last 10 years. In 2010, there are only 2 technology companies among the 5 largest stocks in the S&P 500. Today, if you look at the top 5 in the S&P 500, they are all technology stocks. And they comprise an unprecedented 22% of the overall index weight. These companies last year averaged a profit gain of 38%, whereas overall corporate profits dropped 32%. By the same token, these companies are able to grow irrespective of a negative economic cycle. They are growing their earnings very rapidly, and for that, they sell at a higher PE, and high PEs in the stock market are here for the foreseeable future. The stock market is not overvalued. All you have to do is how the market has done during the so-called overvaluation period. And most days this week, the market has moved on to record highs.
Yeah, and it's interesting because again, I taught financial services in my 20s, and what you were just talking about, Robert, is the stock market's only overvalued, in my opinion, if you have a short-term horizon. You know, if you're young and you've got a long-term horizon and you can dollar cost average, even if the market drops, you're just buying stocks at a discount. You know, so I think we get caught up a lot of times that, because I dealt with this with my parents, this recent drop a couple months ago or a year ago, I don't look backwards. My dad was a little panicked. And I had to explain to him, I said, as long as you don't sell, the markets drop. You only lose if you sell. And there's a lot of panic and misunderstanding, I think, that exists in the market where investors just don't understand their strategy. And I think the press drives a narrative that drives fear into people.
Well, I tell people when you invest, never read the headlines because they'll force you to do something possibly that you really shouldn't do. Your comments are well taken. And personally, I know 3 investors that became spooked because of the pandemic and sold out all their equity holdings. Now, they sold out a lot lower than the market is today. And as the market started its upward watch or march, what they typically do in a situation like this, they've sold, the market's higher than they sold. They wait for the market to pull back, and it's like catching a falling knife.
Yeah.
You're never gonna catch up. Now, this is a very important point too. Along those same lines, we had a 5-week bear market in February, March of a year ago. And Barron's charts a standard portfolio for most investors, which is balanced between 60% stocks and 40% bonds. After the market recovered by 38% on June 30th, only 12% of investors were fully invested in their equity portion of their account. So they shot themselves in the foot. They sold low. The market moved ahead. They failed to participate. And that's why when you invest, it's very important to take a 5 to 10 year horizon, close your eyes and not look at the stock market for 5 or 10 years. It's necessary to block out all these distractions, all these viewpoints, which often can be very negative on both the economy and stock market. And I've often said this, sometimes in order to be a good investor, it's more important to have a strong stomach than a strong mind.
Yeah, and we may end up moving into that. We do a lot of work now in blockchain and crypto, and the volatilities and swings are high. I just did one of my little shortcasts the other day. If Apple's trading at $130 and it drops $13, that's a 10% drop. But $13 doesn't matter. Bitcoin's trading at 60,000, has a 10% drop at $6,000. So the press, as you said, the press drives narratives that scare people. But you said something I agree with, Robert, is I don't think people know what their horizon is for investing or what their return is. If you want, low risk, long return, that's a certain strategy. If you want medium risk, higher return, but if you want high risk, high return, I think people get caught up, as you said, in the headlines and just do a disservice to their investing. They're always investing at the wrong end of the peak and the trough.
Very true. Many years ago, Putnam Securities did a study on their growth fund, and they looked at their investors that were market timing over a 10-year period, and they found that the investors in the growth fund achieved 25% of the overall return over the 10-year period. So it's another example. There's never been any evidence that people can successfully time the stock market. Time in the stock market is far more important than timing the stock market, Stephen.
Yeah, and again, as you're saying, that's where I think people need to understand they'll come to me all the time. Oh, what should I invest in? Especially with GameStop and Robinhood and the retail side or the crypto Bitcoin side. People say, well, what should I invest in? I have $10,000. Should I buy this or that? And it always comes down to what's your time frame? What's your horizon for that investment and what's your expected return? And
Well, I don't think white people should be investing in stocks. It's hard enough for the professionals to beat the stock market. Over the last 15 years, it's shown that 87% of funds are unable to beat the stock market. When I speak to investors and investors speak to me about where to invest, I implore them to buy market baskets of security.
yeah.
Because when you own an individual security, the next morning you can wake up and find that your stock is down 25 to 35%. When you're buying market baskets, those types of drawdowns never occur.
Yeah, the swings aren't as violent. Yeah, we've looked at that a lot, and we used to see the studies long ago, and I think somewhere around Putnam in the days when they would look at a 10-year horizon of a stock, as a trader actively trading in that return versus that same investment in an S&P 500 or an index fund, and they're invariably almost the same, or the index usually outperforms the stockbroker over 10 years. So
this is a very simple story. If you enter the workforce with some college, maybe college degree, and you have a good paying job, if you put $5,000 a year away in some type of retirement account for the next 40 years, so basically you're going to put 5,000 in when you're 25, 26, 27, and you repeat this exercise until the age 65, and assuming a normalized market return over that 40-year period, you're going to walk away with more than $3 million.
yeah,
You don't have to pick stocks. All you have to do is buy the S&P 500, and you will beat the vast majority of professional money managers. It is so simple and so painless, but people feel that they can do better.
yeah. The one we used to teach, and I still do a lot, I like sharing, is dollar cost averaging, where you can show somebody a stock that goes up consistently over 3 months, or one that starts, drops down to a big dip and goes back up. You're buying on that dip. And as long as you have the stomach to just be consistent long term, you're going to be, your own gut of trying to buy in and out of stocks. So I think it's some interesting things. Looking ahead though, Robert, again, the technology side has changed a little bit with the stock market, the electronic trading now. There's a lot of things that technology has changed and improved on the stock market side. It's also hurt some people because the big institutions can make these micro trades and little retail guys miss out on that. What do you see as some of the changes going forward, either as investment strategies or how companies and retail consumers may look at and view and use the stock market?
Okay, I used to own, in my passive portfolio, I've owned for many years ETFs, small cap and mid cap. And the reason why I own those two vehicles is because smaller companies can grow their earnings faster, and they're rewarded with higher returns more so than the S&P 500. I think today we hit a sea change early this year with the pandemic, because technology companies, many of them were able to grow through the economic contraction. And the stock market today is different, in my view, than it ever has been in time. Going back to the Axe Houghton stock fund in the 1970s and 1980s, the fastest earnings growth rates I could find were 30 to 40%.
Okay.
In that type of environment, we had a domestic economy, globalization had yet to take hold. What does technology mean? Technology means that some companies can grow their sales and profits faster than any time before. Technology means that some companies, large companies, can grow their profits by 100% more in any given year. For this reason, technology now constitutes 33% of the overall weight of the S&P 500. It is demonstrated that negative economic cycles are not going to cause these companies much pain in terms of their profits and sales contracting. And I have taken all that money, my passive money that I've had in small cap and large cap, which includes the restaurant industry, the airline industry, the lodging industry, the casino industries that are going to take many years to recover, if they recover at all, and redirected that money to the Qs, because over the past 10 years, the Qs have done twice as well as the spiders. So the Qs have returned over 10 years, ending 2020, 537% versus 267% for the S&P 500 ETF. And I think this is going to continue as we go forward.
So looking out on the horizon, the next, 10 years, decade, we're coming out of post-COVID. We think economies are recovering. There's some changes going on in the US with administration. So there's some uncertainty around tax and regulation. Where do you see the economy and the markets as a whole heading the next 3 years and maybe the next 10?
I don't know about the next 10 because at some time, this monstrous debt that the US is creating is really going to catch up with us. And Congress today has little understanding about business. I don't understand why we continue to elect lawyers to manage the biggest business in the world. The whole focus of the current Congress is that we ought to float debt because interest rates are low, not giving any recognition to the amount of debt that we have created in the system. At some point in time, this debt's going to have to be paid back. It probably never would be paid back, but it's going to have to be serviced. And if interest rates move higher, the United States is going to be in big trouble because interest as a part of the budget could grow to be as much as 50%, crowding out all other areas that government is very important in, like Medicaid, Medicare, unemployment insurance, healthcare, things like that. But over the short term, the next 2 to 3 years, we are going to have a very nice party because of all the stimulus that has been injected into the US economic system. So the market will do well, at least for the next 2 or 3 years. And if anything, it's going to surprise investors on the high side.
And so this question will be a little bit of inside baseball. Some of my audience will get and understand this question and some won't, and that's okay. But we started noticing a real trend around corporations actually just doing debt and bonds as opposed to equity. And so now the companies, the corporations have this massive debt hangover. That same thing, they're using debt to fund operations. They don't want to do the stock. If interest rates rise, the corporate debt, not just the United States government debt, but the corporate debt, that overhang is getting really heavy also. Do you have any thoughts on that, or is that a metrics you've looked at all?
Well, the government holds a substantial amount of debt, and most of those numbers are public and can easily be seen. 20 years ago, at the turn of the century in the year 2000, US debt was $5 trillion. In 20 short years, our debt has grown to $30 trillion. Historically, the average interest rate on Treasury bonds has been 4.5%. We are currently at 1.7%.
Yeah,
if we get anywhere close to the historic average, we are talking about interest in servicing US debt going from $300 billion a year to 1.2, $1.5 trillion. And if we have to pay more interest on the debt, we'll be forced to spend less money in other areas. So the arithmetic is not very pretty.
Yeah, and that's kind of what we've been watching as well, is what's going to happen on the debt side, but then the other side, and I don't know if you look at this aspect at all, but have you looked at at blockchain and the token side of how companies are starting to use money using the new technology? Is that something you've looked at all?
No, I'm first and foremost, yes, I'm a money manager, but I'm first and foremost an analyst. And it's very, very difficult to be good in the investment at one thing, let alone many things. My specialty is investing in growth stocks, and that's where I spend all my attention, and that's where I put all my dollars. I do very nicely. Golden Eagle strategy is doing very nicely.
Yeah.
It's up in the past 11 and a half months, including the first week of April, 130%. I don't need to look at other areas. And if I start looking at other areas, I may give up my edge in what I'm doing. So I just focus exclusively on growth stocks.
Yeah, perfect. Yeah, where I was leading with it is a lot of times, like, we get offered, we'll get offered IPO opportunities where companies are using the stock market to raise capital. It's usually growth companies, and there's going to be interesting new strategies that'll come out of how companies raise money. But like you said, if you're at the growth stage level, that's not, a lot of the stuff I was referring to isn't gonna change that. So
yeah, there are certain areas like cryptocurrencies I'm not involved in. I don't really, quite honestly, understand it, nor do I want to learn how to understand it, because it takes time away what I do best.
And I appreciate. I'll explain it to you in 5 seconds. Cryptocurrency, they're glorified penny stocks. That's the cryptocurrencies. They're not currencies. They're not payment. They're not bank. You buy a penny stock on the OTC bulletin board. You buy a stock at 10 cents because you hope it goes to $1. All the cryptocurrency stuff are just speculative token assets. That's it. Anybody that tries to claim them something different, they're not.
Yeah. On our approach to the stock market, we're investing in very fast, predictable earnings growth companies that have franchises that either have software or biotech products that are difficult to duplicate. And that's where my expertise lies. And that's where it's going to remain, because what we do does very well, and it's enjoyable doing. When you do something well, you get a lot.
Yeah.
It's not only monetary gratification, but you also get psychic gratification, knowing that you're doing something well.
Exactly. And like you said, if the risk profile, the time frame, the horizon, strategy, all of that for the lane that you're in, you're doing great. So Robert, I appreciate your time, the insights, the information, hugely helpful. Again, I like to bring a span of different people to the audience, and the lane that you're in serves a great purpose who want that kind of return and strategy. So I appreciate your efforts, and I appreciate the time.
Thank you, Stephen. I've enjoyed talking with you this afternoon.
All right. This is Stephen Meade, the Bullseye Guy podcast. We'll be back next week.